of income tax, I draw you this diagram. IAS 12 income tax. We have current, we have deferred. So to get current tax, between us and government, company, us and government, we make money, we must pay tax. So we have current year provision, CYP, current year provision, plus current year provision plus under or over provision, last year under provision. This under provision is previous year. Current year plus previous year under provision. It can also be current year provision minus previous year's over provision. Easy. Yes. So you can put prior year lah. Prior year under provision or prior year over provision, previous year. And the previous year is not necessarily just that immediate previous year, can be 2 years ago, 3 years ago. Deferred tax. Deferred tax asset. Deferred tax liability is future. This one will be deferred tax asset will be deductible temporary difference, DTD, taxable temporary difference, TTD. Unabsorbed business loss, unused credit, unused tax credit. So for DTA, we use this here. DTA, deferred tax asset, page 132. Deferred tax asset, we have a star. Why? Because they should be recognized to the extent that it's probable that taxable profit will be available against that which it can be utilized. Means we have a condition, okay, to recognize our deferred tax asset. And the condition is we only recognize to the extent that is probable that taxable profit will be available against which it can be utilized. So I'll write it there. Is recognized to the extent you copy down to the extent that is profit is available for it to be utilized. Against which it can be utilized. Okay. BTA. The future profit is available against which it can be utilized, it can be used. Okay. So SPL, we have sales cost gross, and then we got other income. We have the expenses, admin expense, distribution, and then we got finance cost. We got the profit before tax. We have tax. Okay, tax. And then we got the profit for the year and OCI, right? What is in the OCI so far? We have the revaluation surplus or reserves. We have the increase or decrease in your equity, fair value of equity, fair value of shares lah, equity instrument, right? A financial instrument. And actually there are two more lah, 2 or 3 more, but high level. So we focus on tax here. So tax is your current tax plus or minus deferred tax to get this amount. Income tax. Okay, this standard here is IAS 12 income tax. So income tax, our company income tax here is actually made of current tax between us and government. I make money, then I must pay tax. Just now, our our current tax is our current year provision. If I make money, I must provide more. Make more money, provide more. But we have to adjust for previous year under over provision. So this is actually between us and government. Deferred tax is purely accounting adjustment. Deferred means tax, deferred means future. This is now, this is future. So purely accounting adjustment. So our SPL is actually made of these two, current and deferred. So we start off with current, the easier one. This year I make profit, and we will calculate our PBT, your tax, you calculate PBT, then we plus and minus capital allowance, depreciation, deductible, non-deductible expenses, we got the chargeable income. So from the chargeable income, we times with 20% tax rate. So the tax is 10,000, so we're going to make a 10,000 provision. So current year provision. However, last year, my tax is actually higher, okay, because I have underprovided. So last year is 2 underprovided. So this year, my current year provision will be charged. This is under provision. However, if it is over provided, I minus from this year. Okay, this is under provision, this is over provision. Done. Current year provision plus and minus. This 12,000 will appear here. Current year provision, current tax. And we still got one more deferred tax, okay, in which we're going to calculate later, plus or minus if it is expenses. 12 is an expenses, deferred tax expense, then we plus. If deferred tax income, then we minus. That's a plus or minus. Okay. So current year settled. Let's try now. Look at the notes of page 126. We look at some definition here. Accounting profit is the profit that we can see from our SPL. Accounting profit, and we know our tax is not based on accounting profit, it's based on chargeable income. So that chargeable income is our taxable profit. Chargeable income, our taxable profit. Yeah, F6. Tax expense, okay, current tax, deferred tax liability, DTL, and DTA. Remember DTA, we got the star there, condition. Temporary difference, okay, that one later. We look at current year. This particular standard, current and deferred. So we're going to start with current first. Example. In year 2 staff, HUD has got a taxable profit, not accounting profit, but taxable profit of 120. In previous year, income tax on 211 profit has been estimated to be as 30,000. Last year, 30. The income tax is 30%. So last year provision 30. Calculate the tax payable and the tax charge for 212 this year. If the tax due for last year was subsequently agreed with the tax authority, means the LHDN, our tax for last year should be 38. 211 should be 38, but we provided only 30, right? So it's under provision. So this year, our profit is 1200, so we're going to calculate the current year provision. 30% will be 36. So this is current year provision. And we have to adjust for last year under provision of 8, plus or minus? There, 36 plus. $36 is current year, and this is under provision plus. Done. So current year tax will be 44. B. My tax estimated last year is 30. B. The tax authority say my tax only 25. Good, I provided 30. So I have over provided 5. So this year provision is 36. minus 5. Done. Current year provision, that's it. Can I? Okay. Now deferred tax. Before that, we try to familiarize with the term. So for deferred tax, we may have deferred tax asset, we may have deferred tax liability, DTL, DTA. So when do we have deferred tax liability? Liability means we're going to pay tax in the future. So we're going to pay tax in the future, we must do something now. It means we're going to recognize liability now. This is about future. Okay, deferred means future. I'm going to pay. That's why here, the reason why we have a deferred tax liability today is because in the future we have a taxable temporary difference. It's taxable. Taxable means have to pay tax. So we recognize liability. Therefore, TTD will give rise to DTL. A TTD, a taxable temporary difference today, will give rise to DTL, liability today. Deductible temporary difference means in the future is deductible, good. So in the future, good. So I am allowed to deduct tax, which is good. So what do I do now? I recognize the asset now. But the recognition of the asset is subject to, it is, we only recognize to the extent, up to the extent that it is probable that future profit is available for us to utilize it. So I use this example, unabsorbed business loss, unused tax credit. So normally we use this one and this one. This one is for other thing, okay, tax credit. So unabsorbed business loss, example, this year I make a loss, 5,000. 500 easier. If I make a loss this year, do I have to pay tax this year? No, no need to pay tax. F6, right? Tax. So what do I do with this 500? Can I carry forward next year? Yeah, this $500 I can carry for next year. If next year I make $800 profit, do I have to pay tax on the 800 or 300? Because I can utilize this 500, right? So when next year I make a profit of 8, my tax will only be based on 3. Why? Because I can utilize the 5. So loss itself is not good. But the advantage is in the future, if I make a profit, I can utilize it. So for me to pay lesser tax. So it's a loss, but luckily this $500 loss here, it can help me to pay lower tax in the future. So is this good or bad? Since already is a loss, but in a way I can reduce tax in the future, so I can recognize the deferred tax asset now. So unabsorbed business loss is a deferred tax asset because in the future is deductible. So what I do now is, since the future deductible, today I recognize deferred tax asset. Okay. So how much do I recognize? You see, 800 I should be paying 30%. But now I pay only 30% on 300. So I save 30% of the 500. Means I save 150. Agree? I save 150. How? The 500 I times with 30% tax. So I save 150. Therefore, I recognize deferred tax asset 150. This asset here, in future, I'm able to save. Okay? So recognize 150. Take the losses, you times with the tax rate. But what if my profit in the future, I think because the business I make losses, I think for the next year, because of, let's say I sell handphone, this handphone here maybe is quite popular, but in the future I do not sure because I do not have any new model coming up. This model, if I launch, popular for this year, but maybe in the future I don't foresee any more future profit. So next year I foresee my profit to be only 300 lah. Or can I use another figure, 200? Otherwise it will be same as this too. I only foresee myself making 200. After which, the following year, I may start to make losses again. So next year, will I be able to utilize this 200? I suffer loss 500. I make a profit. Do I have to pay tax on the 200? By right, yes. But I got 400 loss previous year. So I can utilize how much? So I can utilize 200. What about the 200, 300? Following year. But I foresee myself making loss in the future year. So will I be able to utilize the remaining 300? Maybe no. Therefore, the deferred tax asset I should recognize up to the extent that it's probable that future profit is available. So my future profit available for me to utilize 200. So I can utilize only 200. Therefore, the deferred tax I recognize only up to 200. The balancing, I don't foresee myself utilizing it, don't recognize asset. So, no, because you don't foresee yourself utilizing it, means it's not a benefit to you already. The 500, but I utilize only 200 for C. So I recognize only 60 as my asset. I'm only able to utilize 60. 200 lah, means the asset is saved 60. You see, the first example, will I be able to utilize all? Can. So I get to benefit all 500 times 30%. Recognize 150 asset. Okay. If I make $500 loss, second year, because my product, the product line is deteriorating, outdated, I'm not launching any new product, I don't foresee myself making loss, profit in the future. What do I do with this 500? Do I recognize deferred tax asset? No. I won't be able to utilize. Future, no profit. So I'm able to utilize, don't recognize asset. Okay. If I can utilize all, means next year I can make 800. I'm going to utilize all. What do I do today? I can recognize asset for this 500. If I foresee myself only utilize 200, out of this 5, I can only utilize 2. Recognize asset only for the 2. Okay, that one will be next year, right? Actual. But what if one is today? Yeah, today. I foresee myself here with 200, 200. Recognize the 60 here. But the profit may be higher, maybe lower, doesn't matter. But what we want is the future. At today, we probable, we estimate. Normally, how you estimate? You look at the budget. You ask the client, why you make losses? This is a higher level. Why is this company making loss this year? Oh, because the product line is very, very old. No new product is being launched. Confirm the losses will be continued. You ask another company, let's say, why losses? Oh, because this year, my factory, the plant got fire, caught fire. So I suffer losses 500. But luckily, we got insurance. And the insurance money we have claimed and we are rebuilding it. So do you think this losses is a recurring losses? It's a one-off losses. So reasonable means they're going to foresee future profit. So we have to understand why they losses, and then we have to make judgment in the future will there be enough profit or not. Recurring losses is going to be recurring the losses, yeah, ongoing already. Therefore, may not have future profit unless they say we're going to launch a new product. Like Proton, we're going to launch a new product. Oh yeah, okay, very popular, good. Okay. So DTD will give rise to DTA. TTD will give rise to DTR. Okay. So how to recognize in our book T account? I show you the ledger, deferred tax. This is our deferred tax account. In the first year, I have a taxable temporary difference of 1,000. We will learn how to determine the temporary difference. The difficult part of deferred tax is how to determine the taxable temporary or deductible. It's not about the double entry. So let's say I calculated and I have a taxable temporary difference. So my tax rate is 30%. So in the future, I'm not able to, but in the future, I'll be taxable 1,000. So means in the future, I'll be taxed how much? 300. Yeah, 30% means 300. Asset or liability? Deferred tax liability. Taxable means need to pay. Means I'm going to have a liability now. So 300. Liability is credit side. I recognize a liability of 300. So income or expenses. Yeah, liability increase. Expenses 300. Liability 300. Is it okay? Okay. Second year. First year settle. Second year. Calculate, compare, and now I got a taxable temporary difference of 2,000. Taxable in the future, so 30% will be 600. So it's a DTL. So in the second year, it will be a DTL. Liability will be here. So from 3 become 6, up by 3. Is it okay? Expenses. Third year, 1,006 is also TTD. So 30% will be 480. TTD will give rise to DTL. So third year DTL is 480. Income or expense is an income. 600, 480 income. Yeah? Okay. Balancing. The following year, year 4, compare, and now I got a DTD, deductible temporary difference of 500. So in the future, I can deduct 500 from my tax. So I'm going to save how much? 30% will be 150. So deferred tax asset recognized now. In future, deductible 500 means I'm going to save 150 asset. Asset is this side, 150. From a liability, 480, drop to become an asset. So income expenses is an income 630. You have to calculate. We haven't learned how to calculate yet. How to determine. So it's 480. This is 0. And now we have this liability, this asset of 150. So from here to here is 630. A liability becomes an asset. So it's a difference of 630 income. So now we notice something. Deferred tax can be expenses. Expenses, it can be income, it can be income. It can be liability, deferred tax liability, deferred tax liability, deferred tax liability, it can be deferred tax asset. So it can be anything. Income, expenses, asset, liability. Okay, how we use, we have to determine is it a TTD or DTD to determine asset liability. The movement will determine is income or expenses. So here from 0 become liability 300, increase in liability, expenses. 3 to 6, increase in liability, expenses 3. 6 to 48, drop in liability, income. Liability to asset, of course, is good. We just find the balancing. Okay, so this is how we determine deferred tax. In what? Okay, later we have the account. So you charge the SPL, income and expenses. This importantly, this is an expenses. So credit here means you debit to SPL expenses. Remember, we haven't include current tax. Remember, current year provision, under over provision. So it can be income, it can be expenses. So if I use this first year, expenses, right? Then current year, from the previous example, current year and under over provision 2000, and my deferred tax is expenses 300. So expenses, also expenses, so we plus. So this one will be 12,300. So our tax in our SPL is actually made of current and deferred. Okay. So 12,300. Just now? This one. Pause this. Okay, for TTD, DTD, we are comparing, to get TTD or DTD, we are comparing carrying amount with tax base. Carrying amount here with tax base. Carrying amount is the value in our SFP, balance sheet approach, means your SFP approach. We use SFP to determine the TTD, DTD. We use SFP to determine the TTD, DTD. So we use SFP carrying amount, compare with the SFP, the tax base. Okay, now, so tax base, what is this? This is actually your tax SFP. Okay, now, example, how to determine TTD, DTD? We take carrying amount, we compare with tax base, we have the difference. Temporary difference. This temporary can be taxable, this temporary difference can be deductible. So how to determine TTD, DTD? We compare these two. Okay, the carrying amount is the value in the book, SFP. So knowing that our SFP, our accounting is always on what basis? Accrual or cash basis? Our SFP always at accrual basis, accounting. But tax can be accrual basis, can also be cash basis for tax. Can be accrual, can be tax. If both accrual basis, do you think there will be difference? No. Between us carrying amount in our book with tax should not have any difference. So one of the reason contributing factor for the difference is because we use accrual, but tax use cash basis. Okay, now tax can be cash, can be accrual basis. But ours confirming accrual. So we use this example here. John Kill buy equipment 50. on the 1st January 21 and depreciate it on a straight line over its expected life of 5 years, means depreciation is 10,000. It has no other non-current asset. So this example, take note, only one asset. No other asset, it's just one asset only. For tax purpose, the equipment is depreciated, means for tax we can claim capital allowance, initial annual allowance of 25% per annum on a straight line basis. Okay, so the capital allowance 25% will be yeah 12,500. Depreciation we claim 10,000. Accounting. But for tax, we can claim 12,500. Am I claiming more? Yeah, that's why we call it the accelerator, like faster. Okay, so accounting profit for the year, accounting profit before tax. Accounting before tax for 21, 22, 23, 24, 25 for 5 years is 20,000 per annum profit before tax. So this one is many years. So just want to highlight to you this example comprised of only one asset, and we're going to show 5 years. One asset over 5 years. Okay. Tax rate is 40%. So we look at over the 5 years, what's our temporary difference over the 5 years? And it's only one asset. Take note here, when we buy asset 50, we can claim depreciation over 5 years 10, 10, 10, 10. What is the total amount depreciation I can claim? 50. 5 years, 50. 50,000 asset cost, I can claim over 5 years 50,000 depreciation. Good. Fully claim I can over 5 years. So my depreciation expenses profit, when I claim my profit will down, 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 down. So I can fully claim 50. Capital allowance, when I buy 50, tax, we call this the qualifying expenditure. QPE means I can claim capital allowance. How much? 25%. What's the total I can claim? Total. Of course, this one 25% means 4 years only. No, my question is 50,000 QPE. Can I claim all 50 capital allowance? I mean, over the years? No. Maximum? 50, right? So depreciation, when I buy cost 50, I can claim 50 depreciation accounting. For tax, when I buy 50 QPE, I can also claim 50. So accounting, I can claim 50. Tax, I can claim 50. But it's different here. That's why we got temporary difference. Understand? So this is SFP in our book, 50,000. We claim 10,000 depreciation. So our net book value is 40. But for tax, the QPE, we can claim 12,500 accelerated. So 37 in our book, the residual. So from tax point of view, this is accounting, this is tax. I claim 10, here claim more. So what happened to my taxable profit? Lower. So am I paying lower tax this year? Government, I pay lower tax. Okay, so current tax, I pay lower. But just now we already discussed 50-50, I can fully claim 50-50. There should not be any difference. So this year I claim extra 2,500. So we look at this carrying amount, compare with tax base. Carrying amount 40, tax base 37,500. The difference is 2,500. We call this taxable temporary difference. Why? Because this year I claim extra 2,500. Means in the future I have to pay another 2,500. is taxable 25. You see, accounting, I still got 40. But for tax, I can only claim 37.5. So I left with 25, which cannot be claimed anymore. So this is a taxable temporary difference. Means I have to pay tax on 25. So what's the tax now? 40%. DTA or DTL? DTL. Is the amount of tax that I will have to pay in the future. Yeah, because this year I claim more, right? Means in the future I can't claim anymore. So 25. So this year one, we have a taxable temporary difference of 25. Hence 40%, we have 1. What do I do? Balance brought down 1. Liability 1000 also. So this is how we get the TTD. Once you got the TTD, DTL, then this is how you do. Second year. Again, depreciation accounting, we claim 10 depreciation, but for tax, we claim another 12.5. So we claim now another time 25 extra, accelerated. So I pay government lesser tax because I can claim more. So far, what's the difference now? Carrying amount minus your tax base. I have claimed extra 5. So meaning in the future, I have to pay another 5. Taxable temporary difference. So 2,000. The third year will be same thing, 3,000. Fourth year will be 4,000. So we do until 4 years first, year 5 later. DTL, DTL, DTL. 4 years. Okay. Can you write here current year? You squeeze in somewhere. Current year. For first year. Because I claim more capital allowance, I pay government lower tax. Current year will be lower. Can you see? But deferred tax, can you see here? Up 1,000. Current year I pay government lesser tax, but I know in the future I'm going to pay 1,000 extra. So this year I recognize 1,000 expenses. So deferred tax come in and balance it off. Okay, now second year, the temporary difference now is 2,000, which is a deferred tax liability. Current year, again I claim extra 2,500. So I pay current year lower tax, but my deferred tax will come in and balance it off. Liability is 2,000. So expenses in my SPL will be 1,000. So the same thing for year 3, year 4. We do together. I mean one shot like here. 7, 5, and 10. Expenses, I claim more, current year lower, but deferred tax come in is an expenses, expenses. year 5. The same as that. Year 5. Accounting, I still can claim depreciation accounting 10,000. So accounting profit lower. For tax, do I have any more capital allowance to claim? No more. Means my taxable profit now is higher. So in year 5, okay, even though I use the asset, I cannot claim capital allowance anymore. So I'll be paying more tax to government. So current year tax, I have to pay more. But you look at the difference now. Yeah, both accounting and tax both claim 50-50. No more temporary difference. So no more temporary difference, no more deferred tax asset or liability. So year 5. No more temporary difference, no more deferred tax liability. So balancing, of course, 0, this one will be SPL 4. Yeah, it is an income. Year 5, because I can't claim, current year I have to pay very high. But luckily, deferred tax come in as an income to reduce my expense. It's a balancing. Okay, not? Possible is possible. This one, it is an income. There, 600 taxable become so liability 480. It is a liability, but it is an income because it drop in liability. For which, for this question, no deferred tax because no DTD. DTD deductible means asset. So you see, in our tax between us and government, first year, second year, third year, fourth year, because I claim more, I pay government lesser. Because we know that both can claim 50-50. So I pay lesser means 1 year I'm going to pay more. In the year whereby I cannot claim capital allowance. So 1 year I'm going to pay more, which is year 5. So deferred tax, because I claim more. So deferred tax means in the future, this is future. Deferred tax, I'm going to pay more. So I recognize expenses now. But over here, in the future, no more liability. I recognize the decrease in liability. It is a decrease in income. So it's balance it off. Take note, this is only one asset and over 5 years. You see here the effect. Next page. This example here, the profit is 20,000 over 5 years. With deferred tax adjustment, meaning this one is without deferred tax, without 20,000 accounting profit. For tax, we must add depreciation. Then we less capital allowance. So taxable profit, we claim extra 2.5. So our taxable profit is 17.5. 40% of this 75 is 7,000. So 17. This one is 20,000. My book profit before tax. My provision is only 7,000. Because I claim more, so I pay lesser tax. So 20 minus 7, 13. 20 minus 7, 13. This one is without deferred tax. So this is a reported profit. Second year, I add depreciation. I claim 12.5, I claim more. So I pay tax only based on 40% on 17.5. So it will be 7,000. So 20,000 minus my provision will be 7,000. This is my current year provision. Third year, fourth year. Let's look at fifth year. Because fifth year, I claim depreciation, I got no more capital allowance to claim. So I add depreciation, no more capital allowance. So my tax will be based on 40%. So I pay my current year provision to government, I'm going to provide 12,000. So 20 minus 12, my profit net is 8. No deferred tax. Can you see? How is my reported profit? 13, 13, 13, 13, and then suddenly 1 year it becomes 8. Why? Because this year I have no more capital allowance to claim. Yeah. So before deferred tax is introduced, if you are the user of this company, and just like I told you, it's only one asset, right? Can you see how our profit is affected by just one asset, which is 50,000? Profit 13, 13, 13 in one particular year suddenly can drop almost half to 8 because no more capital allowance to claim. So if you are a user here, this company here, which year will it suddenly reverse, and then whereby the profit will suddenly drop? You will know. So you become the investor here, you have to anticipate, wait, how? When is it going to drop? And it's only one asset. Imagine company with many, many assets. The profit can drop quite a lot. So it becomes difficult to predict. And then user will have this idea in mind that 1 year the profit will drop. And bearing in mind that both 50,000 can be claimed fully, accounting and tax. And profit is like this. Because we claim lesser, then suddenly we cannot claim. Therefore, with deferred tax in, we want to eliminate this uncertainty. Here, deferred tax, expenses, income. How? Future taxable. So yes, current year provision 7, because it's between us and government. I claim more, I pay lesser government tax. But in the future, definitely I'm going to pay more. Deferred tax come in there. 1. You can see from here 11114. So it's 20,000 minus 8. How to get the 8 there? $7,000 is current year. 1,000 is deferred tax. So it's 8. So my tax I'm going to charge in my P&L is 8. So 20 minus 8 sharp. 20 minus 8 sharp. We look at year 5. Because I have to pay more tax, sharp. Luckily, deferred tax come in, it will reverse. It's an income. Still sharp. So our profit, reported profit, will not be affected by the temporary difference. Okay, conceptually, it's quite easy to understand, but in practice, not easy. Because there are many more. You did before, right? It's not easier. Very difficult to concept. Yeah. This one. That's 20 minus 7. Profit before tax minus tax. Profit after tax. This one purely current year only. But deferred tax come in, it will now becomes equal. It's not affected by the temporary difference. Okay. So you can see here 7,000 is between us and government. 1,000 is purely our accounting adjustment. Okay. And it's one asset, many years. The question will be no, not like this. This has to understand the concept of it. Why we have the temporary difference. We have many more. So let's stop this video first.